Hello, I'm Dominic Hobson, co-founder of Future of Finance. My guest today is Michael Shaulov, CEO and co-founder of Fireblocks, which was set up with the express purpose of bringing to the digital asset markets the level of cybersecurity institutional investors have come to accept in the traditional financial markets. And that is the subject of our conversation today. Michael, thanks for joining us.
Thanks, Dominic, for having me.
Now, we catch you coming fresh from having completed your Series C funding. You've raised $133 million. It's bringing your total investment to 179 million. It's come not just from VCs this time, but from a major global custodian bank in the shape of BNY Mellon, who is taking a strategic interest in your business. Now, that fact alone suggests that digital assets are going mainstream, and if digital assets are going mainstream, Fireblocks finds itself sitting on top of a volcano. What does it feel like to be sitting on top of a volcano?
Well, I think it's definitely an exciting moment for us, and definitely an exciting moment for me as a CEO and co-founder of the company. It's definitely very good problems to have. Still, sitting on top of a volcano means that we need to be very committed to the scale and to the rapid expansion that is currently occurring in the market, and our ability to really serve those clients, to make sure that the offering that we have is applicable to the new players that are entering the market. And it's good problems to have. Those are still the problems that we are executing and continue to execute against.
Now, as I say, the involvement of BNY Mellon is in itself very interesting. Can I ask you what they're expecting in return for taking the strategic stake in your business?
So I think the main thing about the Bank of New York Mellon is that they are definitely the biggest bank right now that is strategically moving into this space in high velocity. We've been working with them for about 3 years or so on the initiative. So it's very exciting moments for us that it's coming to market. Of course, they sort of announced their plans about a month ago. They mobilized a huge amount of people internally and hired a lot of people from the industry to basically focus on this initiative. For us, and I think for the industry, basically the combination and the partnership between Fireblocks and Bank of New York Mellon is really the best of both worlds, right? It's really the most trusted brand that been there for the last 200 something years, right? Coming together with the best of breed technology and the most, I think, respectful technology player in the digital asset market. And I think that to your point earlier, the combination of the two will really create an infrastructure that not only the existing traditional market participants can basically jump in and participate in this market, but they will also be able to participate in this market in the best way possible, having access to the most advanced and the most secure technology. And also, as Fireblocks, our claim to claim is to really provide this open access, clearly with the restrictions that Bonnie has, but really to provide as much advanced technology and advanced offerings as possible from a compliance standpoint.
And what would you say to those many people who would argue that this is the beginning of a relationship which ends with BNY Mellon acquiring your business?
Yeah, I think that to be honest, so just to double down on or explain the composition of the round, right? Most of the funding in this round is actually coming from the biggest VCs and fintech investors, so both Coatue Management, Rabbit Capital, Stripes, and so on. For the guys that are not familiar with Coatue, they are backing, PayPal, Square, Alipay, some of the biggest and most dominant fintech players. Clearly, the amount of funding that came in this round, the most important aspect here is that it actually will allow us to remain independent. It really puts the valuation and the amount of funding internally for the company that we can really optimize for the long run. We can build the infrastructure. People can rely on the fact that the infrastructure is going to be there. And whether you are a client of Bonnie, you're in the same bucket of participating and competing with Bonnie, or you're a fintech vendor or a crypto native, you can rely on the fact that if you're using Fireblocks as an infrastructure, we're going to be there for the foreseeable future as independent vendor.
Yeah. Now, as you said, you started talking to BNY Mellon 3 years ago, which is not long after you set the business up. So you saw this institutional grade cybersecurity opportunity in cryptocurrencies, long before most people did. At that time, it was mainly a retail investing activity. So here we are 4 years later. What assurance can you offer institutional investors in the area of cybersecurity?
So I think that one of the people, it's a bit strange that someone who basically sells the cybersecurity offering, the most secure offering in this space, saying that there is no silver bullet, right, in cybersecurity. And I'm saying it as someone who's been, I think, a veteran of the cybersecurity industry for the last 20 years. And the idea behind our offering is really a multi-layer approach of how to protect the asset, how to protect the assets from external hackers, how to protect the assets from insider threat, and how to protect it from even errors, technology errors, or operational errors, right? The Fireblocks technology and the implementation that we are putting in place with the biggest banks, including the ones that we are working with right now, really sort of guarantees that there is a multi-layered security protocol systems and technologies that are best of breed. And through a series of penetration testing, through a series of code audits, through a series of security architecture review, sort of guaranteed that this is the best approach to protect this asset class. And last but not least, eventually, all those layers were evaluated by leading, AAA insurance providers. And we as Fireblocks, we have insurance capacity that we carry ourselves. And also our customers can actually, on the back of using our technology, obtain direct insurance capacity on that.
Now, the digital asset safekeeping itself is quite a technical subject, but clearly the methods of securing digital assets from being stolen by hackers have evolved very considerably in recent years. Could you just run us quickly through the story from that first generation of solutions, the old cold storage and the multi-sig, the HSM, which was the leading thing at one time? Can you talk us through the story to the current generation and explain a little what's been driving those changes from one type of security to another?
Yeah, of course. So in the beginning, right, people had to solve probably the most important issue around the security of those assets. The first one of them was the ability to protect the private key, right? Because the ownership on the private key is really what determines the security or the security that you have on the account. The initial attempts, or it wasn't an attempt, the initial approaches were really to use HSMs and multi-sig solutions. And they were basically invented back then in 2012. And although 2012 was less than 10 years ago, in crypto, we always joke that this is basically dog years, right? So it's almost 70 years old technology. And the deficiencies over there were twofold. The first one, we only had Bitcoin back then. So this technology, multi-sig technology with HSM, works well for Bitcoin. It doesn't really work well for the newer blockchains like Ethereum, like Polkadot, like some of the more advanced blockchains that are currently available. And the second issue that is actually exists is that they don't provide the ability to quickly interact with the asset class, right? So they were created for a buy and hold period, right? When people were buying Bitcoin for $100 and were waiting for that to appreciate. And over the years, of course, the market have moved into a much more transactional, high velocity type of activity with a lot of trading. And I think where the future is clearly even more of that, right? Around payment use case, around remittance use case, around security tokens, and so on, right? So the multi-sig HSM technology is not equivalent, not capable of applying that to this asset class. And for that, basically a new form of technology was created. It's called multi-party computation, or MPC. It's much more flexible. It's similar to multi-sig in the sense that it disintermediates, or basically removes a single point of failure and creates a decentralized security mode in which even if one endpoint or one server or one individual is compromised, they cannot compromise the entire system. But the MPC technology is just more capable from an operational standpoint to deal with all the blockchains, and also to be and our ability to basically merge this with a trusted execution, which is a more flexible form of HSM, is allowing you to really interact with the coins, with the asset class in high velocity. In the last 30 days, we've done over $110 billion of transactions that were issued through our infrastructure across north to 600,000, individual transactions. So you cannot do it with basically multi-sig and HSMs.
Mm-hmm. Now, one of the things you talk about your MPC model, you've still got private keys, you've still got APIs moving data around, you've still got a need for addresses, and I guess digital assets have to be delivered to a new address when a transaction takes place, much the same way as a conventional payment or securities transaction has to be delivered. But one of the things you've said is that you eliminate the need for deposit addresses. Can you explain that to our audience?
Yeah, so one of the second challenge, by the way, from a security standpoint, and this is very non-trivial for people that are coming from the traditional financial space, is that the blockchain technology is sort of open, right? So unlike in the traditional space that it's a closed system, and basically every account can be identified by some kind of a very clearly understood alphanumeric sequence, like CTUS / Palo Alto / whatever branch number, and then the account beneficiary. In cryptocurrency, this is just a random number, right? This is basically just a random long streak that identifies the wallet on the other side. Now, and this is basically the public key. So in order to make a transaction, someone is the recipient need to send the public key, which is again a random number, to the sender. If basically that process is spoofed, right? There is a hacker that is standing in the middle of the transaction, or even the sender just made one error, right, in terms of putting 0 instead of 1, right? That transaction is not going to end up in the destination wallet. And the main issue is that there is no recourse, and transactions are being settled immediately, right? So it's not that you can call Citibank or you can call Swift and tell them, hey, reverse my transaction, right? So what Fireblocks created is the Fireblocks network that is basically an authentication layer. It's a messaging layer. It's, people describe it as Swift for crypto, but effectively that eliminates or secures basically those transactions. And you actually, as a sender, you don't need to basically obtain the deposit address from the recipient. You have a directory. The directory, there are, you can be public in the directory, you can be private in the directory, but eventually you have a directory, and you basically click on the recipient, you push send, and it guaranteed to you that the transaction will go through to the receiving wallet. And one of the most interesting facts over there is that there is also even like an E&O insurance that protects the technology to do that.
Mm-hmm. So in a way, we're replacing bit codes and IBAN numbers with these random numbers, which you access through a directory, right?
Yeah.
Okay. Now, these digital assets are going to have to be serviced as well as custody. You're going to have to pay transaction fees to brokers and others, custodians. You're going to have to, some cases, collect income on these assets. Do they create a fresh type of vulnerability, or is that solved by the same MPC technology you've described?
Well, it's mostly solved at the basic level. The servicing, right, is solved by the same technology, because at the end of the day, the servicing of interacting with a smart contract, issuing corporate actions on programmable instruments is also solved by MPC and the interaction. Still, there are still areas that need to be covered. For example, when the smart contract is being programmed, it's critical to make sure that it's being programmed properly, and there are no vulnerabilities in the smart contract, but at least the access from the servicing entity is secure.
Now, obviously, the original purpose of blockchain was a trustless network. You would be trading anonymously. Are these institutional networks going to be closed systems? And in that case, are we going to get questions of identity coming up? Do people want to know who they are dealing with? And if they do want to know who they're dealing with, how do you do that? Are you using two-factor authentication or biometrics, or digital identities have some role to play here?
So it's a very, very good question. I think that we will see how things evolve in the. I think there is sort of like a midterm and a long term here, but in essence, this technology, no matter how much we would institutionalize it from a compliance standpoint, it's an open technology, right? So, and I think the beauty of this technology is that eventually you will have people that are individuals that can interact with the asset class, and they can do it from their own self-custody ledger nano. And you will have huge pension funds that will basically access this technology through, the most traditional institutions like Bank of New York Mellon. And on the long run, I think that the regulatory frameworks will allow the later, right, the banks eventually to, in some shape or form, to interact with the individuals, right? The main questions are eventually, there are two main questions that come in the form of identity. The first one is credit, right? Are we able to create some kind of a credit system over there that is based on identity, right? And the second aspect is really AML, BSA, right? That, of course, like, it's not only, I think, that the idea behind what the regulators want, or maybe like, the regulators trying to enforce, but, personally, I don't want my services, or I don't want people that I service to provide services for, anti-money laundering, terrorist financing, and all the bad stuff that in the earlier parts of my career, I was, working for law enforcement agencies and intelligence agencies. I think that, definitely to protect against those activities is critical, right? So identities are a big part of it. I think that part of what the Fireblocks network provides is essentially, and it's an open network, but at least it does give an identity and the validations that the people that you interact with are compliant. Every participant in that network defines his own subnetwork, and the sub, basically, it can both extend it to people that are not currently in the network, but it can also determine what is the subset of institutions that, from a compliance and the counterparty risk standpoint, they're willing to interact with. I think that, providing this flexibility and providing this offering is critical, but I do think that identity is going to play a major part in this, not only for the compliance reasons, but most importantly for the ability to create a more, more advanced services in the form of credit and lending.
So you think we can maintain open networks, but still keep financial criminals out of the network without closing the network? Is that right?
Well, I think that financial criminals will always be there, right? I think that the main question is how we can gate them and how we can basically make sure that their ability to propagate into the mainstream is confined. I think that some of the solutions that are proposed today actually are not going to provide that kind of service. And I'm talking about it actually with my previous hat, right, of creating technologies like this. What we're seeing here, the transformation that we're seeing here into a much more anonymized system, we've already seen that in other areas. For example, internet communication, mobile messaging, right? It's like the battle between FBI and Apple is, one of the most was one of the most public battles around, privacy via security in the recent history, right? And eventually the law enforcement agencies and the regulators, they understand the technology and they understand how to sort of migrate their tactics and enforce enforce, the regulation and the rules that I think are important to all of us in a way that is native to the technology. I just think that this takes time, right?
Okay. Well, talking of financial criminals, one of the things that put institutions off coming into this market earlier was, of course, the stories they read about hacks on cryptocurrency exchanges. Now, those are mainly inside jobs. They're mainly a thing of the past now. I was interested to read in the CipherTrace report that DeFi has now become the major target of financial criminals in the last year or so, mainly because of weaknesses in smart contract coding. And anyway, their conclusion is that DeFi is now the major vulnerability in cryptocurrencies. What does that mean for institutional investors of the type you'll be serving?
Yeah, so we've actually put a lot of effort into DeFi in the last couple of months. This is very applicable to a subset of our customer base. It's basically most of the hedge funds and the prop traders that are fairly comfortable with dealing with DeFi and entering into those protocols. The vulnerabilities in the smart contracts, which by the way, not all of them are. There is something which is quite unique over there, that in many of the cases, it's actually not a traditional code vulnerability. It's more, there is a financial logic exploits in terms of how they behave under extreme market conditions, such as like flash loans and basically sort of like stretch conditions that suddenly the underlying market or the underlying asset doesn't behave as they would expect, and that allows basically an attacker to cash out a huge amount of assets. So it's quite interesting. I mean, the type of things that we're seeing over there. Overall, there are firms that are focused on auditing and providing stretch tests on the smart contracts. But look, everything said, DeFi is a very experimental space right now, right? Anyone who is basically playing in that space, including a lot of our customers, is very familiar with the risks that they're taking, and their investors are familiar with the risks that they're taking. There are huge rewards over there, but I don't think that the banks that are basically like, the layer part of the people that we are servicing is rushing into DeFi with, huge amount of AUM tomorrow morning.
Mm-hmm. And you touched on this in some of your earlier remarks about the human factor. And, as we've learned from conventional markets, the rogue employee, the colluding employee, the fat finger, the USB stick, the email attachment, and simply the inadequate internal process, lack of four eyes, if you like. Do all those factors also apply to digital assets?
Yeah, one would argue that more than anything else, right? I think that in general, as our life become more and more digital, right? And that's like across the board. And I think over the last year, clearly there was a huge transformation. We sort of discover more and more, I think, how the human nature is not always, adjusted to how digital works, right? And that goes back to people. There is a joke in cybersecurity that where the human a human being is a computer that when presented with a question, should I open it, yes or no, is a machine that will always press yes. so that's just like the nature of people. One thing that I should probably make comment, and this is just my philosophical view on cybersecurity and how IT is being developed. The way that IT was developed over, let's say, in the last 2 decades, is that it was very sort of technocentric, and because it was very technocentric, it actually created a lot of those pitfalls that people basically fall from cybersecurity, or just errors and things like that, right? I think that over the last 5-6 years, we've seen a fairly strong commercial, basically consumerization of that. The people that done it the best is probably Apple, right? With the iPhone, that most people that they have iPhone, they don't really think about security. Apple basically bakes security into their platform. Apple bakes a lot of the issues that you can basically be exposed on Windows machines or Android devices and things like that. They've done a really good job in creating a technology and creating a product where, as a human being, there is like very little room for you to make mistakes, right? They still have a lot of work to do over there. Nothing is perfect, but they sort of showed us that you can actually create a secure infrastructure. And our philosophy in Fireblocks, and I think that this is something that people that are actually operating in our asset class, they need to be very mindful of, that at the end of the day, we need to be continuously thinking about how do we create this infrastructure secure by design, right? When it's being shipped from the factory or shipped by the developer, it is secure. It doesn't allow people to do things that they will regret later on because they didn't notice what they were asked for.
When your technology goes out into the marketplace, you yourself have used the term subnetworks. We're talking here of networks of networks of subnetworks of subnetworks. You've got exchanges, custodians, market makers, investors, and so on. So you've got data and value, sloshing around these networks all the time. And it's when something it moves that it creates vulnerability, presumably. What are the limits on actually preventing assets being? I mean, this is the heart of your business, really. How much of your time and money and thinking it goes into trying to control those movements, if you like, the actual point of the transaction?
Well, I think 99% of our time is being spent there. This is at the end of the day the point of vulnerability, right? Of not. Maybe 99% is a bit over exaggeration because there are other things around resiliency, backup, and so on that are critical to. But at the end of the day, the most critical gate is eventually just a second before the asset moved, right? Because when it moved, there is no recourse. So the amount of technology that we have over there in order to basically validate, put the guardrails to make sure that it goes to the right place, but also to put the guardrails that from an insider standpoint, we are making sure that an insider cannot interact with it. That there is a workflow that our customers can program multiple steps in terms of how this is approved, and there is not only no single point of failure from an IT standpoint, but also there is no single point of failure from a human standpoint or from a process standpoint. This is the vast majority of where we invest our technology and innovation in terms of creating a lot of different multi-factor authentication, in terms of enforcing it in hardware, in terms of creating robust policy engines that people can program to the way that they work.
Now, you use the term there, no recourse. Is there no recourse? We've talked in the past about burning assets, effectively canceling mistakes, if you like. Is that not an option?
That's an option in security. That's an option in tokenized assets. So on tokenized assets, you do have recourse, but clearly, something like a native cryptocurrency such as Bitcoin, that's just the virtue of the idea, right?
Mm-hmm. So scalability, that's been another long-standing concern of institutional investors. Has that challenge been overcome now?
Yes. So I think that, depends on what layer. I think in the custody layer, in the settlement layer, it was overcome. There is still scalability issues on the blockchain layer itself in terms of how many transactions a blockchain can clear. But again, we have the brightest minds that are currently working on that. And I think that at the end of the day, Bitcoin aside, right, when you look at all the other protocols, whether it's ETH2 or Polkadot or Algorand or Stellar or Ripple, at the end of the day, this is all a race to scalability, right? This is all a race to who will be the first protocol that will create a very scalable and decentralized network that can operate in the transactions per second in a TPS that traditional finance is currently working at in a centralized form.
Mm-hmm. Now, I said at the outset, you're sitting on top of a volcano. You're now starting to see private banks, wealth managers, asset managers, and corporate treasurers starting to invest in a relatively narrow range, but are investing in cryptocurrencies. What sort of credit do you think that the cybersecurity specialists like yourselves can take for that development? How large does cybersecurity loom in the minds of these organizations investing in crypto?
I think it's significant. I mean, it depends. When you look at all kind of service and report, you always see cybersecurity as either like the second or third question that people have or concern, right? I think the fact that we were able to create trust and we were able to create the ease of use for those institutions is a major factor. I think there is also a chicken and the egg over there, right? The fact that we don't see a huge exchange being breached on every afternoon. It's definitely part of what allows the market to go up, right? I still remember the days every time that there was a hack, the market would tumble.
Yeah. One last question for you. You used the phrase a minute ago about race to scalability. I sometimes, when I think about cybersecurity, it feels like a Red Queen race in which you're running very fast to stand still. You're in this constant evolutionary battle between cybersecurity specialists and hackers. What's your secret to actually keeping ahead, or at least ensuring you're able to stand still in relation to the hacking community?
So this is an approach that we're definitely taking here at Fireblocks. This is a project we took in my previous company, and I think that philosophically, this is the approach that you see with a successful cybersecurity company, is that your ability to think like a hacker and your ability to continuously learn the hackers and how they changing their procedures, right? Tactics and procedures, right? I mean, probably the most fascinating thing about cybersecurity is that it's sort of an ever-evolving space, right? You are not facing a technology, you're not facing a performance bottleneck, you're facing a real opponent that is on the other side of the ocean, right? Sitting, or maybe like he's in the building next to you, right? You don't know, but they're basically thinking about it in the same way that you are. I think one of the biggest advantages of that our team have is that we have a lot of capacity of people that understand offensive cybersecurity based on their military background and intelligence background, and also the fact that they spend a lot of time in working for cybersecurity companies. Israel is considered to be the cyber nation, and there is a huge amount of talent that we pull out of over there. And the second aspect, which is just continuous learning, right? So we continuously monitor and learn what hackers are doing in this space, and we sort of stress test ourselves against their most recent tactics, and we challenge ourselves if the ideas and the concept that we've engineered yesterday are still valid for today, and if they're not, we have a framework of how we mutate and adjust to that.
Michael Shaulov, thank you very much.
Thank you, Dominic.